Hello traders! Are you aware that accurately pinpointing and charting the market structure is a fundamental yet frequently underestimated skill in trading? In today's chapter of our Smart Money Concepts course, we'll take a closer look at a skill that's often overlooked, but makes a real difference in trading results: knowing how to read and map the market structure. In this video, we'll cover both basic and advanced concepts of market structure, along with practical tips to map it effectively. You'll also learn how volume and big market players influence price movements, key elements to stay ahead in the market. So if you like this kind of video, please like, subscribe, and turn on notifications. And join the ComLucro community to support the channel and keep improving as a trader. Now, let's get started with the market structure. The behavior of market movements can fundamentally be attributed to two main factors that consistently dictate the direction of prices: trends, which encompass both uptrends and downtrends, and the consolidation phase, characterized by choppy or ranging markets. Picture this as a perpetual cycle, where prices continuously oscillate between downtrends, uptrends, and consolidation periods, each gathering liquidity and institutional orders. Typically, prices need to consolidate following uptrends and downtrends. A vital initial step when analyzing your charts is determining whether the market is currently experiencing an uptrend, a downtrend, or is in a consolidation phase. To build a robust understanding, let's start with a straightforward overview of market structures before exploring the intricate details of advanced market dynamics. Consider an idealized version of a market structure reflecting a perfect uptrend. I term this as ideal because it's rare to encounter an uptrend in real markets that follows this pattern precisely. Markets don't usually move with such predictability. Nevertheless, to enhance our understanding of uptrends, let's examine this ideal model before shifting our focus to the more realistic uptrend structures that are more commonly observed. In a typical uptrend, prices will consistently create higher highs and higher lows. The pattern generally sees prices surpassing previous highs while sustaining the lows. An uptrend concludes when there is a break below one of the significant lows. To preserve the continuity of an uptrend, it's essential that these major lows remain unbroken. Additionally, when a price exceeds a major high, it results in a structural break and forms a demand zone, indicative of a break of structure, or BOS. Accurately identifying major highs and lows is crucial because it allows us to recognize signals for potential trend reversals or continuations. Without correctly pinpointing these key points, traders are at risk of misinterpreting market signals and potentially entering trades on the wrong side of the market. These principles are equally applicable in bearish scenarios. During downtrends, prices consistently form a sequence of lower lows and lower highs. In such scenarios, prices tend to break below previous lows while still respecting the previous highs. Let's explore the details of a realistic market structure, focusing on the more commonly observed uptrend patterns in the market. Consider a scenario where the price surpasses previous highs, breaking upward. At this juncture, a key question emerges: how do we pinpoint valid major highs and lows? To address this, let's examine the left side of the market structure. It is evident that the price underwent an upward trajectory until it began to retrace. The peak reached before this retracement is deemed the major high. Conversely, the lowest point during the bullish wave that triggered this upward movement and led to a break of structure and a new high is recognized as the major low. These 2 points are the critical external structures of the market, and any structure that develops between them is considered an internal structure. When the price surpasses the major high, marking a break of structure, BOS, it indicates a continuation of the upward trend. On the other hand, if the price drops below the major low, this should be interpreted as a signal of a trend reversal. The internal price actions within these external structures are secondary, provided the price stays above the most recent major low. Maintaining this condition signals that the market remains in a bullish phase. You might wonder why this low at the extreme is treated as the major low. The reason is that it represents the ultimate low point before the price starts its upward trajectory. This particular point is essential as it's the pivotal low that catalyzed the upward movement and the subsequent break of structure. Before we go deeper, let's hear from Linda Raschke, one of the most respected traders in the industry, as she shares how she prepares for the trading day. Notice how she keeps her process simple, repeatable, and always aligned with what the market is actually doing.
For me, what I'll do is I'll go through the markets that I trade and I simply look at, do I want to trade it from the long side or do I want to trade it from a short side the next day? I try to keep it really simple. Or is there some little coil pattern where the possible breakout? So I just make a note of these things on my sheet. It really only takes me about 30 minutes to go through each market. And then I'll step back and look at the big picture time frames and say, well, you know, is there any chance we're putting in a type of double bottom or double top, or is there more significant chart formation? So I'll approach it, you know, what am I going to do for the next day, and is there some significant chart formation on the big picture that I need to be aware of? You know, if you have a game plan, you know it's the wrong game plan too, so therefore it's easier to correct it. It's much better to have an idea and then right away you'll know if that's wrong. So for example, let's say the market's been up for 2 days and I come in thinking, all right, you know, I'm looking to short the market if there's an early rally because it's a little bit overdone. You know, and it can pull back to in the middle of yesterday's trading range. So that might be what I'm thinking in my plan. However, in the overnight action, it may well be that the market sold off, Europe sold off, the DAX is down, and instead we're gapping down, in which case I'll be like, well, I'll see if there's still a rally to short, you know, but it could also be that we gap down and we're making our lows first and we're going to trend higher for the day and close at our highs. So you have to work with the market. And then I'll step back and watch the index futures because they're so correlated with the currencies and the financials, and there's really been a ton of market correlation for the last 2-3 years. So if it's in a liquidation mode, you know, if the S&Ps are selling off, you'll probably have liquidation in some other markets as well. But yeah, I'll go through my 25 markets and try and single out 4 or 5 that might have the can't miss trades on them. And sometimes I won't touch a market for 2 months if it's just not interesting.
As you can see, her routine perfectly illustrates what effective market structure reading is all about. Simplifying your process, focusing on context, and being ready to adjust when the market proves your plan wrong. Now, let's transition to the bearish scenario, which mirrors the bullish scenario. The bearish wave begins, leading to a structural break. We also identify a major low, marking the lowest point reached after the structural break. These 2 points, a major high and low, act as our external structures, while all structures developed between them are viewed as internal. Should the price break these major lows downward, it signals a continuation of the trend as illustrated here. Conversely, if the price climbs above the major high, this would be indicative of a potential trend reversal. In simpler terms, the internal price actions within these external boundaries are secondary, as long as the price remains below the most recent major high, signaling a bearish market. As the price retraces upward, it establishes a series of internal highs and lows within our defined trading range, yet it eventually ascends, breaking the recent major low downward. This internal high, situated at the extreme, is now recognized as the new major high because it marks the highest point reached before the price initiated a strong bearish push, resulting in another structural break. Following this, the price undergoes another retracement, forming another major low. After establishing various internal structures, the price sustains its downward momentum, creating a sequence of lower lows and lower highs. Having examined both ideal and realistic market structures, we now turn our attention to the underlying forces driving these patterns. This leads us into a vital component of smart money concepts, understanding the role of significant market players and the criticality of volume analysis. Large players, such as institutional investors, hedge funds, and banks, play a pivotal role in shaping the market structure. Their substantial capital and strategic trades can significantly influence price direction and market dynamics. By understanding their behavior, traders can gain insights into potential market movements before they become obvious to the general market. Volume is a powerful indicator that often precedes price movements. Analyzing volume can help us identify the accumulation and distribution phases, which are indicative of the activities of large players. For instance, an unusual increase in volume might suggest that smart money is actively taking positions, preparing for a significant move. By integrating volume analysis with market structure, we can better interpret the actions of large players. Look for patterns where volume spikes align with structural market changes. These are the moments when smart money is most likely active, and aligning our trades with these signals can increase our chances of success. To tie it all together, the actions of large players often lead to the formation of the highs and lows we observe in market structures. By mapping these alongside volume spikes and other smart money indicators, we are equipped to make more informed trading decisions that align with the underlying momentum dictated by the market's most influential participants. Now, let's explore another vital concept in market structure analysis, the break of structure, BOS. You might have come across this term in various trading tutorials, market structure videos, and handbooks. Typically, in a bullish scenario, a BOS is often simply described as a situation where the price surpasses a previous high. However, to accurately utilize this concept, specific criteria and rules need to be adhered to in order to confirm a valid break of structure. Let's dive into these key points and rules. A valid break of structure is confirmed when the price not only breaks, but also closes above the most recent higher high with the candle's body. This validation holds even if the price retraces downwards immediately after the break. In such instances, the market establishes a new major high and major low, defining a new trading range. Should the price then break this newly established major low heading downwards, it suggests a potential trend reversal, indicating a shift from a bullish to a bearish stance, a change of character, or CHoCH. Continuing our exploration, if the price breaks the previous higher high with a long wick or shadow, and the body of the candle closes below the high's range, and if the subsequent candle's wick does not exceed the first candle's wick, this does not qualify as a valid break of structure. In this instance, the resulting low is treated as an internal structure within the trading range. For a reliable indication of a trend reversal or a valid change of character, we need to observe the price breaking below the significant low at the extreme, rather than merely breaking above an internal high. Now let's consider a different scenario. If the price surpasses the recent higher high with a wick, and the body of the first candle closes below the high's range, but the subsequent candle's wick exceeds the first candle's wick, we then recognize this as a valid bullish break of structure. Here, a new major high and a new major low are established, outlining our updated trading range. The internal price action within this defined range is less significant, provided the price remains above our newly established major low, which signifies a bullish market. If the price later breaks this newly formed low downward, it then acts as a clear indicator of a trend reversal or a valid change of character. Transitioning to the bearish scenario, which mirrors the bullish one. For a bearish market structure to confirm a valid break of structure, the price must break and close below the most recent lower low with the candle's body. If the price breaks the newly created major high upwards, this signals a trend reversal, suggesting that control has shifted from sellers to buyers. Conversely, if the price breaks the recent lower low with a long shadow or wick and the candle's body closes above its range without the subsequent candle's shadow exceeding the first candle's wick, this is not considered a valid break of structure. To confirm a genuine break of structure, the price must close below the low's range with the candle's body. Moreover, if the subsequent candle's wick surpasses the first candle's wick and closes above the low's range, this then qualifies as a valid break of structure. We must also update our major low and major high accordingly. As long as the price stays below our newly established major high, the market is considered bearish. Only if the price breaks this new high upward do we acknowledge it as a valid signal for a trend reversal or a major change in character. Having explored various types and scenarios of break of structure patterns, and now possessing a solid understanding of what constitutes a valid BOS, let's delve into another key aspect of market structure mapping, the change of character, or CHoCH. The first step in identifying a valid change of character involves determining the general market direction, whether it's an uptrend or downtrend. Next, you need to highlight the valid breaks of structure on your price chart. In the bullish scenario, consider how the price forms a series of valid breaks of structure. The low and high that define these breaks are our major structures associated with the first valid bullish BOS. As previously noted, any price action that occurs between these two structures is deemed internal. Change of character patterns can be categorized into two types, minor and major. For instance, each time the price breaks any internal low, it signals a minor change of character. It's crucial to understand that a minor change of character alone should not be taken as an indication of a complete market structure shift. Here, we encounter a common pitfall in the market. Many novice traders who have not properly identified the market structure often misinterpret a minor change of character as a signal for a reversal in market direction. Believing that the bullish phase has ended, they might think it's an ideal time to enter a short position. Typically, they place their stop loss just above the internal high. However, contrary to their expectations, after a brief retracement, the price climbs again and continues its upward trajectory. This often results in hitting the stop loss of traders who took short positions. They frequently fail to understand why their stop loss was triggered by the price and tend to repeat this mistake. What they miss is a crucial detail. The price did not break the major low that would confirm a shift in market structure. They should not enter a short position until the price breaks the last major low to the downside. Their perceived change of character was invalid, and the price was merely in its retracement phase before resuming its primary upward direction. To capture a valid market structure shift signal, traders should patiently wait for the price to establish a major change of character by breaking and closing below the last major low that initiated the upward movement leading to the bullish break of structure. Furthermore, it's essential to remember that in a bullish scenario, a change of character pattern is only considered valid if the price breaks and closes below the last major low using the body of the candle. If the price breaks the most recent high with a long wick or shadow and then closes within the high's range, the change of character is deemed invalid and cannot be seen as a decisive market structure shift. This principle is mirrored in bearish scenarios. For a change of character to be considered valid and highly probable, the price must break and close above the recent major high with the candle's body. Any penetration merely by a shadow or wick is regarded as insufficient. In conclusion, this video explored the core elements of market structure and the skills you need to read market dynamics with clarity. By understanding trends, consolidations, and the role of major players, and by applying concepts like BOS and CHoCH, you are now better equipped to anticipate movements and make informed decisions. Before we finish, reflect on one essential point about emotional management. Many traders fail not because of strategy, but because they underestimate how losses impact their mindset and decision-making. What happens inside your mind during a drawdown matters more than the loss itself. To illustrate this, we're going to show a short clip from our trading psychology course, taken from the chapter Emotional Management in Trading. Let's take a look. Now, let's start with something simple but real. Losses hurt, not just financially, but emotionally. When you lose money, it is not only your account that takes a hit, it is your identity as a trader. You start to question yourself. Did I do something stupid? Am I really cut out for this? That self-doubt is where emotional damage begins. Psychologists have shown that losing money activates the same areas of the brain as physical pain. That is why you do not just see a red trade, you feel it. It is a punch to your confidence. And when the pain of that loss stays unresolved, it does not just affect one trade. It infects the next ones too. That's why professionals treat emotional pain seriously. They know the real damage does not come from the loss itself, but from the emotion left unresolved. One unprocessed loss can lead to weeks of hesitation, revenge trades, or impulsive decisions. That clip is a timely reminder that consistent results come from discipline, not emotional reaction. The best traders stay grounded, keep structure, and treat trading like the serious performance activity it is. Please also remember that our mission here on the ComLucro channel is to give traders the clarity and confidence they need to make smarter decisions in the market. Every video, every course, and every piece of content we create has one clear purpose: to deliver practical, easy-to-apply knowledge that helps you grow step by step as a trader. Here on the channel, you'll find complete courses on smart money concepts, technical analysis for day traders, and trading psychology. Because trading isn't just about charts, it's also about mindset, discipline, and risk management. We also share lessons and insights from some of the most respected names in trading, professionals like David Paul, Alexander Elder, Tom Hugard, Mark Douglas, Al Brooks, Larry Williams, and many others whose experience has shaped the way we understand the markets today. If you enjoyed this video and found it helpful, please give it a like. It really helps more traders discover our content. And don't forget to subscribe and turn on notifications so you never miss our latest insights and strategies. If you'd like to go even deeper and access exclusive content, early video releases, and additional tools to support your development, consider joining the ComLucro trader community right here on YouTube. It's a simple way to support our work and a smart investment in your own growth as a trader. Thanks for watching, and I'll see you in the next video.